Well, welcome. Session on the economics of impact. Special thanks to the few of you who have made it so early and through the cold morning mist. Grateful that you're here, and hopefully you'll have some great ideas and thoughts for us on this topic. So hopefully it's not just now a presentation, but we can turn this into a discussion and help us bring this topic forward. The economics of impact in a nutshell is about understanding and managing the economic consequences of setting ambitious societal targets in business and within business and with external partners. And we feel and see that the practices of managing the economics of impact will be very important to accelerating the transition to an economy that truly addresses our global challenges. And our goal today is very much to share the state of thinking, the state of practice on the economics of impact, and invite a conversation and exploration of how we might accelerate the adoption of these practices in business and accelerate the adoption of these practices in business also via investors, which is topical for this conference. To help me in that goal, I'm delighted to have colleagues and friends. I have Catalina Martinez on my left, who is a expert in development and impact finance, PhD and lecturer at University of Geneva, and most importantly, a senior consultant at FSG. I have Michael Fürst, who is the global head of social business at UCB, which is a Belgian pharma company focused on neurological diseases. Michael's also spent 16 years at Novartis, addressing some of Novartis' health impact and health access challenges from a perspective of the business, from a perspective of corporate responsibility, investor relations, a lot of different functions over the years. And Michael has also been a supporter and kindred spirits in our own journey on shared value. Helps my colleague Mark Kramer teach its shared value class at HBS, and understand, Michael, that you were once again the star. So I get the feedback from the students via Mark, and apparently it was a wonderful session. And we have Dave Penlington virtually, who was going to be here, but rules changed 4 days ago from the UK. And Dave has been leading responsible sourcing practices, first at Unilever and then Mars Wrigley Company for some 30 years, right, Dave? And just transitioned to joining a consulting firm in the UK called Brody. And Dave and I have had the pleasure to work on the topic of economics of impact and explore its significance, particularly around commodity supply chains. And I'm Mark Fitzer. I'm Managing Director of FSG in Europe, and have been on the journey of influencing companies on their strategy and social impact for some 30 years, and have had the privilege to work closely with Michael Porter and Mark Kramer over the last 15 years on building the shared value practice and movement, and recently have really focused on this topic of the economics of impact. And actually, we have an article in submissions at HBR, which hopefully will be printed and will provide hopefully even more eloquent and clear description of what we're talking about soon. So my job, I will start by framing and presenting what the economics of impact is about, and then my dear friends here will dive in and be more specific about how it applies in specific industries. So a good way to understand what this topic is about is really to sort of confront 2-3 realities we have. If I could have the next slide, or am I supposed to do that? Perfect. I mean, the first reality that we're confronted is that the world really hasn't given up on the primacy of financials in decision-making in business and investing. And we all aspire to better accounting systems, and these are being developed and dreamed and shaped, but they're not here yet. They've been in development for a decade, and it may take another decade to land. And right now, the reality is financials basically still rule. That's the first reality. And we probably don't have as many investors in the room as we expected, but I think we would see them sort of nod. The second reality, and it's actually, is that, we faced a triple global emergency, an emergency on climate, an emergency on resource depletion, an emergency on growing inequality in the world, very well framed by the World Business Council for Sustainable Development that sits in these buildings. And that reality is helping all of us and helping business reshape itself to address these challenges. And business is the most powerful engine we have to address these global challenges at scale. And in that process of doing that, business is setting itself more and more ambitious societal targets. And that's a good thing. And these targets are increasingly measured in more and more aligned ways. That's a parallel process ongoing. It's not perfect. We're still aligning, we're still defining measurement standard, but the process continues to be underway and is actually very useful to managing the economics of impact. But the reality, the third one, is that these sets of targets and commitments are actually completely disconnected from the first set, which is the financial targets that companies set themselves. I became aware of this particularly in conversation with Veolia a couple of years ago with senior executives. Veolia is, a French company, global company with a great purpose, which is to resource the world. And they're into the business of basically helping us reuse, recycle all sorts of materials. And that's a very, powerful and needed value proposition. But senior executives said, on the one side, we have all these, business plans, projections of, revenue growth, profit growth, return on capital invested. And on the other side, we have our sustainable, sustainability plans, and we have our targets on materials, on water, on greenhouse gas emissions, on labor conditions. And we have absolutely no idea whether these two sets of targets are actually consistent or connected in any way. And we think that essentially until we solve that problem and that we systematically link our progression on societal outcomes with our financial projections and outcomes, that we just won't make it. We will under-resource the change, or we will greenwash the change, which is we'll set targets, but in fact, we'll quietly drop them as soon as market cycles get tougher. And so this is a very real, very pragmatic, and very timely way of addressing the problem. We don't have to wait for a new accounting system to understand and manage the economics of impact, which is why we are passionate about this topic. It's why I think in this panel, we have some 80 or 90 years of sustainable practice experience. I think we're at a stage in our career where we need real, pragmatic, and timely things that we can do now without waiting another decade for potentially a new system or for potentially government to intervene or whatever. This is something we can do now. And what we can do now is not take all impacts of companies. We can take the fundamental 2 or 3 impact areas that are most aligned with this company's business model and purpose, and really systematically understand how driving outcomes changes or influences the financial outcomes, understanding the true cost and value of reaching these outcomes for companies, but also for stakeholders, as we will talk about. What's fascinating about managing the economics of impact, it's about internal innovation and change, but it's also about sharing the true cost and value of change with specific stakeholders. So that sounds a little bit abstract. Of course, by industry, it gets much more specific. If you're in the energy industry and involved in the energy transition that we all need, what we're talking about is understanding how you're changing the carbon intensity of energy production and how that influences changes in profitability. My colleague Mark Kramer did some fascinating research. It's actually published in Institutional Investor on how different energy companies are more or less are decarbonizing more or less profitably. And behind those differences are obviously strategic choices. But what may also be behind, and we hope behind some of the differences, is not just smarter or better decarbonization strategies and more profitable ones, but a parallel effort to extend access to energy. If you look at Enel, Italian-based utility, global utility, very much focused on renewable energy production. Another objective they have is to extend access to energy. And that may be, in the short term, a profit dilution, an effort that you're making, which may look you worse on the profit side, but is actually offering in the future a much larger market potential, as well, of course, as providing the basis for providing energy, which is so important to providing opportunities for individuals, families, communities, small businesses, and so on. That's what it means in that industry. Michael will talk more about what it means or could mean as we push these practices forward in the healthcare industry, and particularly the biopharma industry, about how pursuing improved health outcomes for ever larger populations has and can influence changes in profit. And we know that can go in all sorts of direction, and how to manage all the levers that affect whether we increase the quality adjusted life years for individuals and for entire populations. Has many drivers which both affect that one and affect, of course, the profitability of the healthcare companies and the pharma companies. So Michael will tell you more about that. And then we also have, of course, the economics of impact, not just sort of on the product and the revenue side, but understanding the true cost and value of change in outcomes also on the cost side. So on the supply chain side, Dave will talk about what this means in sourcing, and particularly sourcing commodities, and how the pursuit of ever cheaper commodities may or may not come with significant, negative impacts in terms of sourcing from communities that live in poverty, sourcing in from places where the sourcing is associated with environmental depletion. And how do we think about changing these outcomes as a proportion of the cost advantage that we're seeking in procurement, which is essentially trying to beat the market, trying to get always something better than or cheaper than the next alternative. And how do we think about optimizing both investing a portion of that cost advantage to close the gaps to get to a new optimum of outcomes. And that's fascinating work that Mars has been underway and that Dave will talk more about. And so on and so forth. Across industries, we have looked also at the situation with meat companies. And if you look at companies like Tyson that commit to the Paris Agreement, and then you look at their actual rate of greenhouse gas reduction, which is far, far below what they would need to achieve for Paris, you realize that with their current product mix of beef, chicken, and pork, and the pursuit of their business plan to grow these segments, that there's actually no way that they will meet their greenhouse gas commitments, and that you really need to look at the emissions per kilo of protein produced. You need to look at the alternative, even plant-based proteins, and then you can begin to see a trajectory towards a transition, which actually lands you in a place where you are actually more profitable on a smaller asset base, but with much, much reduced, of course, carbon footprint. One of the most powerful, so what we're talking about here, and I'll turn to my colleague soon, but is really having businesses do the math. And in doing the math, what happens is you uncover incredible insights to optimize actually outcomes, both societal and financial, but you uncover also great opportunities for optimizing the outcomes together with stakeholders in those relevant systems. Discovery is an insurance company. I'm sure you're familiar with it. Based in South Africa, now a global company that basically built its value proposition around prevention and of risks, trying to change health outcomes for their health insurance customers, trying to lower the accident risks for their car insurance customers, and now even in banking, trying to raise the savings rates of their banking customers as fundamentally tied with the profitability of the company. And this works this way, is that you invest in incentive schemes that help change customer behaviors on their own health, for example, or on their driving behavior. That has an impact on their mortality or morbidity rates, or on their health, which is a measurable bent in their curve. So they have statistical curves on the health status of their whole membership. And that obviously drives a reduction in claims, hospitalization rates, and so on, the cost side of the insurance company. And what's incredibly powerful about linking systematically here the health or the accident or the savings, wealth increase outcomes, societal outcomes with the business, is when you've got millions of data points, you can constantly optimize and understand what's working and not working to drive even more incremental value on both sides. And so that's what we're talking about. In most of the simple relationships of true cost and value of change to profit that I talked about in the previous slide. In fact, we've got behind these similar longer equations that spell out, the real drivers of both societal and financial outcomes. And when we have these, we're able to then really begin as businesses and of course as investors with that information to understand what's going on, to be able to steer around 4 fundamental strategies. And the first strategy is like the discovery one, or like the renewable energy example, is to just unlock what we call shared value, incremental positive relationship between driving the societal and the financial outcomes. When you've got that information and those insights and deviations in that proposition, you can actually optimize and grow impacts and financials. That's what we call unlocking further shared value. But in many cases, achieving the societal outcome, and we're talking here about the examples that Michael or Dave or Catalina will talk about, actually means being in a trade-off situation. And the first scenario here is to break yourself out of trade-off, to innovate and collaborate. Those will be the examples we'll talk about. The scenarios 1 and 2 is where business can actually do the most in the world to advance our objectives, is through shared value models that from the outset do both, or by finding ways to get out of break out of trade-offs, and having a clear trajectory and business plan to say we're diluting our profits right now because we can foresee the pathway to innovation and collaboration that will get us to a new and better optimum, is what business needs to do, looking progressively forward, not backwards. The third scenario, of course, is to embrace the trade-off, and that can happen as well. We've just seen Amazon or Costco in the US, for example, now raise minimum wage ahead of legislation. They are saying we cannot live with our employee workforce paid at the current minimum wage. You do that because you can financially, but also because you want, particularly as a group of companies doing it, you want to influence legislation to go in that direction and to basically re-level the playing field around a new level. This is actually very close to what the monetization field has in mind, which is to push the legislator towards internalizing externalities. Leading companies can take a step forward, but can only do so much of that unless, without getting to a competitive disadvantage. And then finally, there's the exit. You may find yourself in a situation where you need to explain that you're going to just abandon the trade-off. And CVS did that, for example, several years back, right? Abandoning the tobacco business and cutting $2 billion in revenue. You do that. Why do you exit a trade-off? Because you actually are purpose-driven and you're trying to reposition a company around a purpose that provides a long-term and better opportunity, and you just can't live with a purpose negative component of your business. Now, how you divest is also important. We talked about that in some other sessions as well. You obviously, somebody said you don't want to throw the garbage in your neighbor's lawn. I thought it was a pretty good expression. You want to find a way to get rid of the garbage another way. So that's the essence of what we're talking about. And Dave, to you first to tell us more about how this applies in the procurement and sourcing world, and particularly in your experience at Mars.
Thanks, Matt. Hopefully you hear me okay. And Kathleen, I think I have a slide which you can go to as well, because the view I see is me over Mark's shoulder, which is slightly scary. So if you want to put my slide on, I'll give the context, and then we can carry on.
Could
we please put the slide for Dave? Thank you.
I can do it. Yeah, click. You see it?
Yeah, I do. Thanks, Mark.
Great.
So let me set the scene. And thanks, Mark, for my introduction as well. But let me give an example of economics of impact, and talk about it from a procurement perspective. And Mark, you set up very nicely, talking about how do we manage it, how do we manage the cost of commodities, etc. So let me use the example of Mint for Mars Wrigley, a program that I was closely involved in. And it starts really with back in 2014, 2015, realizing that India, the main origin for natural menthol, is about 8% of the world's production of natural menthol. Yields were declining. There was pressure of water. There was also adulteration of natural menthol as farmers sell to traders and aggregators, and there was actually adulteration. So there were real challenges in sourcing something as humble as natural menthol, used in 6% of Mars Wrigley's mint and gum brands and around the world. So Mars took the decision to lean in terms of actually moving to a different origin would have been incredibly costly as well. So it made sense to lean in and working India, and the logic being working with and building good agricultural practice, understanding how to improve the income of farmers, build the security of a supply chain, as it were. And as we see on the slide here, that was been a process of about 5 years. The first phase of the program finishing at the end of this year, and it's had some amazing outcomes. Working, training 20,000 smallholders, leading to an increase of yield, quite spectacularly, a 60% increase by providing good quality mint rootstock. It's led to a 250% income increase from mint. Part of that is due to yield, but also reducing inputs through sharing good agricultural practice with the smallholders. Irrigation has been reduced by 50% by really understanding when irrigation needs to be made. And part of the program has also been about building income opportunities for the rest of the farming family as well. So through 4,000 women now involved in self-help groups, which has been absolutely incredible, and particularly if you witness it on the ground, very humbling. Understanding something as simple as being able to sign your name as a woman actually means you can actually access microfinancing through the self-help groups. Genuinely humbling and brilliant. Fantastic partnering as well. There's a point about partnering here with suppliers, with a brilliant partner on the ground, Tanager, who's put a lot of the infrastructure in on the ground, but also with suppliers Callison, Norex, Sharp, Simrise, and also partnering as well with GIZ. So putting a lot of infrastructure in place because it didn't exist before. There is no extension service linked to Mint in Uttar Pradesh, where the menthol is sourced. So incredible impact over the first 5 years. Where the program's going next is the realization as well. The program did a living income benchmark study at the start. The program's made fantastic improvements through income through Mint. It is the only cash crop the farmers have, so there's still a way to go. Still not at a living income, but it makes sense in terms of the security of supply. It also makes sense in helping the farmer families generate even more income generating activities, improving the resilience of the families. The logic being, as the income goes up and that can actually pay for education, the income goes up, it also means that better inputs, better advice can be gained. We also, Mars has also created a number of co-ops as well. So the extension will shift from Tanager as the implementing partner on the ground to actually become an income revenue stream for the co-op. The other point as well is realizing that you have to actually tackle the public goods. I think as Mark was alluding to in your opening in your opening conversation about confronting the realities. If water sustainability isn't tackled in Uttar Pradesh, there won't be any mint in the future, but there won't be any other crops in the future. And equally, there's a basic human right of access to fresh water as well. That can't just be tackled through Mint and Mars Wrigley, but with the base that's been created, the next phase is engaging with government, engaging with other partners, bringing others into the rotation and really tackling a bigger public good of water sustainability. So there will be new partnerships, new approaches. It started really as a security of supply program, but the realization through the program is we now actually understand within the procurement organization the cost of that investment, and because we actually also know what it would take if you actually shifted that and started work in a new origin. That's an incredibly important insight. The other piece that I should add here as well is that this work has been through the procurement organization within Mars. The sustainable sourcing team is part of the commercial procurement function within Mars. So it's joint strategizing together, building this program. So securing supply, but equally driving impact in line with Mars's purpose. And I have to say, the procurement team and sustainable sourcing team with that joint objective has been brilliant. What's possibly maybe surprising, I don't know, but is once you work with brilliant procurement professionals, they too are driven by purpose too. So you can certainly line up brilliant procurement and driving purpose and put it in a business context. I'll probably stop there, Mark, because I know you want to ask me some questions, and we can talk a little bit more about why this is so important and why particularly I'm so passionate about the value of procurement teams as well, and really understanding the economics of impact as well, and how you actually understand that and frame that within a business as well. I'll stop there. I've set the scene, I think.
Yes, thank you, Dave. If I may, I think what you just described also fits in a greater context of Mars having something called the Sustainable in a Generation Plan, I think, saying that it will take us a generation to address these issues. It's not going to be done overnight. And it identifies the critical impact areas, the few impact areas that Mars thinks it can most advance through its entire commodity sourcing globally. And there are 6 or 7 issues, of which wages and water and with a cross-cutting lens on gender are part of the plan. And what's particularly powerful about the Mint work is I think it shows the beginnings of seeing that generation plan, not just from a we need to change the outcomes on those issues, but put that in the context of our cost advantage in sourcing. And you were not 100% explicit, Dave, if I may, but there's a portion of cost advantage from sourcing cheaper mint in India that's deliberately being allocated. I think I can say how much, Dave, because we have it in the article. It's over 10% of that cost advantage, which actually raises a question, should it be more, to drive change in particularly living wage and water outcomes in that particular commodity. And that's incredibly powerful because we are really linking and managing both sides. The other thing is that, right, the true cost of closing wages is not the wages, it's investing in a different way of farming. That's how you invest to close that gap sustainably. And so there's a chance that you won't have to just pay higher wages forever, but by closing the gap, you actually will ultimately end up with a new optimum. Probably not the full cost advantage because prices will also increase, but you'll end up with a new optimum on your sourcing cost versus a commodity that no longer bears the burden of those negative impacts. So that's incredibly powerful. But yeah, the question I would love to raise, and this goes a little bit to my poke on the 10%, could you describe this is a continued tension between sourcing and sustainability, and Mars has unified those two functions between, getting the cost advantage and needing to deal with these outcomes, and really integrating those two perspectives. But where are the teams in managing that tension, and our procurement staff really incentivized now to balance those outcomes? And what will it take, if not yet, to do that?
Thanks, Mark. Easy question. Good. But a good question. And I think in terms of where the procurement team is, I mean, they are responsible for delivering the impact, and as you rightly said, in the Sustainable Generation Plan. So one of the impacts of the Shub program is income and women's economic empowerment. So not only do they have to deliver the cost advantage, security of supply, but they also have to deliver the impact gain as well. So the second phase is about tackling how to raise the living income. The point for me, though, is it makes complete sense for the procurement team to be directly involved because of that sort of deep understanding of what it takes to improve the yield, to improve the security of supply. You also know what it would cost, as you say, with the cost advantage if you had to move to a different origin. And it's really wise that the program started when it did, because if it started now, I think as you're alluding to as well, the true cost of change is only going to get larger. So better to be deeply invested, deeply understand it, and have it within the procurement team, that understanding. Because my next point is, and in terms of the embedding within the business, you really can begin to frame that in terms that the procurement organization understands. If you keep it perhaps too sustainability focused, then you perhaps could lose the procurement organization. But another way of talking about economics of impact is the total cost of ownership. So knowing the investment needed for security of supply, knowing that actually will drive a more competitive sourcing of mint as well, because as the yield increase, as the income gets better, the farmers will be uplifted and the families will be uplifted. And so creating co-ops as well, you get a better quality of mint oil, you've taken out the adulteration, so actually it's costing less. So if you frame it in total cost of ownership, the procurement team absolutely get it as well. They love the purpose, they don't necessarily have to understand all the detail behind it, but framing it that way, and also understanding the should cost analysis, we could just say, well, what should menthol actually cost? And part of that should cost is you have to tackle the income, you have to tackle the water sustainability challenge as well, because then that becomes the should cost of your security of supply. So if you begin to frame it in those ways, I think that's a great way of accelerating the economics of impact, because it makes complete and utter business sense within a procurement team. So, you know, leveraging the procurement team's skill as well is you're not only making it more competitive, you're delivering purpose and impact as well. So for me, it perfectly aligns, but you've got to frame it and keep framing it in a way that the procurement organization understands it. And your point about the cost avoidance, absolutely right. And you can make an informed decision, which is what a business needs.
Yeah. Great. Thanks, Dave. And obviously it puts a new burden, an economic burden in a way on the sustainability teams to actually forward project what the true cost of change and true value of change is, which is allows for, you know, actually looking forward on that and having that dialogue with procurement. And that's flexing a whole sets of new muscles as well on the sustainability side. And also to understand how much of that true cost or value is actually within the company or outside, as you say, with particularly the water issue. So, which I think is a great segue for Catalina to tell us more about, this particularly looking around commodity supply chains, that the true cost of change may not be actually what you think it is, right?
Yeah. Thank you, Mark. Thank you. It's a pleasure and honor to be here today. So we wanted to share with you an example of how we're thinking about this for the supply chain of sugar, which actually is, it has a lot of human rights issues. And we're going a step further without stopping at the farmer level, and start thinking about all the workers that are involved in the supply chain. In particular, we're talking about the cutters that cut sugarcane. So here we are really talking about social issues that are the hardest to address in the whole ESG spectrum, no? And one of the key issues that we wanted to share with you today is how we are addressing it through collaboration. One of the things that David mentioned was the fact that Mars alone cannot really solve the issue that they were discussing in terms of mint. And here what we realize is that also collaborating across many multinationals that are sourcing sugar from these locations that have these human rights violation problems is key to really address the core of the issue. But going to your question of really understanding the economics and really being surprised what it is that is really driving the situation, is the fact that what we did here is really try to understand the economic incentives of a labor market that is completely informal. So these are cutters that are really, they are hired by an intermediary, and it's completely informal, and the brands don't have any idea of who these people are. They don't have any way of tracking them, no? So usually if you just see the ESG indicators, you will ask the corporations to report on the, for example, child labor in their value chains, but they just don't know who these cutters are. There's no way for them to track them. So what we did was really try to understand how are the economics of these people that are invisible for the moment for these value chains. And we were surprised to see what you were saying, like really if brands do the math, there are many ways to really unlock value and optimize and identify efficiencies and ways to be more effective. So basically what we unlocked is that basically it's not really about paying more the farmers so that they can pay more the cutters. This is usually what you will see in a certification scheme. What we could see is that really understanding what are the incentives, the economic incentives of this labor market that is completely invisible at the moment, is key to really know what you could move and what you could change so that really impact is driven. So that's why we were surprised, basically. So here in the slide, what we have is a quick summary of a year of work that we have been doing with these three leading multinationals that source sugar from Mexico, but also from many other countries that have the same issues. And this issue of human rights violation is not only specific to sugar, it happens in many other supply chains. So I think these insights can be applicable to many things. So basically what we saw is here we have three stakeholders at that level, beyond the farmer. You have the farmer, the cutter, and what it's called in Spanish, the cabo, which is the intermediary that hires the cutters and really, takes this cutting group of people to the different farms of sugarcane farmers to really cut sugarcane when the harvest is ready. And in the top table, what you have is the status quo. So basically, what really the farmer can control is how good they apply, fertilizer or agricultural practices, irrigation, all these things that are technological agricultural practices. And they are paid on that. Basically, as a result of the agricultural practices that they have, they get paid based on the sugar content or the sucrose content of their sugarcane. So that's fine. But the cutter and the cabo really cannot control the sugarcane content, because really they are not the ones that are implementing the fertilizers or doing all these agricultural practices. They are just cutting, really. But now they are being paid based on that sucrose content and the weight of the sugarcane that they bring to the mill to process and create sugar that is ultimately sold to the brands. So there is a disconnect between the things that they can control and the things that incentivize them, basically. And what we are proposing is really to align those incentives better, to pay, for example, the cutters not based on the ultimate weight of the sugarcane at the end of the harvest, but really on the quality and the speed in which they are cutting. No? So this is a very, very simple insight, but it's completely revolutionary because it's completely different of how sugarcane is cut and brought to the mill. So really, basically, the idea here is to really, understand the economic incentives, not only how much it costs to really change the labor conditions of these people in terms of, having better protective gears and access to water and access to household, housing that is appropriate. That's actually the traditional approach. You just quantify that. That's important too, but it is really important to understand what are the economic incentives that drive them and how you can really change that so that you can have a change that is sustainable over time. So basically, that's, I think, the key thing that I wanted to share on that example.
That's great. Thanks, Catalina. And, it's been amazing, amazing work. I think the first thing we understand is not just where value is created in the chain and who's making money and not making money, but then you understand how the system is essentially designed smartly to protect the downstream players who do have the highest margins in the whole and profit in the whole chain. Because if you look at this, the field yields are essentially, subject to, seasonal, weather-related types of influences. And if you carry some of that, you put some of the burden of that fluctuation on the workers, then you've protected some of the downstream players. So, but in fact, changing the compensation system, you discover actually doesn't, because of the inequities in the system today, because of the lost productivity of a bad system, actually doesn't cost the amount of closing the gap. And you also discover that in this process, the untapped potential in field yields is much more value even than anything we're looking at in terms of wage increases. So if you simultaneously really work with growers and make sure that then not just one party in that system captures all the value from the yield increases, you actually have plenty of value to pay very good wages all the way upstream. So, and that's fascinating, but it needs to be managed as a collective. Otherwise, the profits will go again back into the hands of one party. So, and then we realize that the cost of transitioning to a new system shouldn't be borne by any one actor. It should be borne by the supply chain based on who's going to get which upside of value over time. So managing the economics, understanding and managing it we started with high-level equations. In detail, it gets a little bit more complicated, but ultimately it gets you back to profitability and closing wage gaps in this case. But as you see, what's behind it, the long equations are slightly more complex, which we think is also the case, Michael, in the healthcare space, where we've got this dual agenda to obviously extend the benefits of healthcare to as many people as possible, more equitably, to drive this change in quality adjusted life years, which is a good metric and not a perfect metric, as we know. And doing so, we know, can be done sometimes profitably, but in many cases cannot be done profitably. And maybe you could explain a little bit more why that is and how complicated the equation behind it is, but how manageable potentially it also is.
Yeah, thanks, Mark. Unfortunately, I can't show a slide because maybe there's not such a great example in the industry. it's possible, but you know, one thing is interesting. If I would speak with a pharma executive about the title of this conference or of this panel here, they would say that's exactly what we do. We are creating a lot of impact with the medicines that we are producing, and that's actually true. You think about how society has changed over the last 150 years. The lifespan has increased dramatically, and not only, but also because of medicines has been invented. So I believe there is a clear idea how economical activity in the industry can have a considerable or huge societal impact, patient level, society level, etc. And I think the industry is doing this fairly well when you look into the typical market segments where the big pharma companies, but also other global multinationals are operating in, which is the top income segment. We know the business very well. We know in principle very well how to create impact. We develop great medicines that are really tapping into unmet needs, etc. Now, what we are sometimes forgetting is that there is a huge segment within the global population where our business activities don't work, or don't work as well as they should. And therefore, we don't really know what kind of an impact we could create if we would tap into those segments with new business models, with new economic models. And that's, I believe, something where we have to challenge ourselves and develop a better understanding what the impact can be if we make a trade-off decision between, should we now invest into, let's say, the development of a new drug, which will create a marginal impact in terms of qualities, as an example, for a patient? Or would it be maybe from an economics of impact perspective, a good idea to invest much more money into driving business model innovation so that we can reach the many, many, many underserved on a profitable basis, but with a much bigger impact from a quality perspective if you look at it from an aggregate level? Because it can make a huge difference whether a patient has no drug or has a drug. That's a big quality difference that you would create. Unfortunately, as said, our business models don't work. And typically when you come into those kind of trade-off decisions, the financial markets, as an example, would reward the first thing, right? You need to put all your money into R&D and then create a new miraculous drug, which will have an impact at the individual patient level from a quality perspective. But since maybe the marginal or the profit levels would be lower for, let's say, social business activities, this would not be done. And I believe it has to do that we don't really understand how this economic activity can drive impact. When you look into impact measurements in our industry, it looks pretty depressing. And again, I'm not talking about the benefits that you see in the clinical studies. These benefits are pretty clear, and this is pretty clearly defined and articulated. What I'm talking about are the benefits and the impacts that we are creating when we try to reach underserved patient groups in the market segments where we have no operations. What you will find in the reports of pharma companies is typically a number which is called patient reach. Is this an impact indicator? I'm not really sure. I'm not really sure whether this is the impact that we should measure in order to really understand whether the economic activity that we are driving or should drive are creating the right quality result. And therefore, I think the industry needs to challenge itself much more and come up with a better idea what kind of metrics we want to use to understand the economics of impact, going away from input and output indicators into outcomes and impact indicators, which is not easy to do, but needs to be done. And only if we create, let's say, this basic level of understanding of indicators and metrics and also create the right data availability, I believe we will be able to do what you have in mind when you talk about economics of impact. But it would help a lot in internal discussions, because when you, let's say, make a proposal to drive a social business activity without being able to show what the correlation between the activity and the impact is, you will typically not win that debate and the trade-off discussion. That the money allocation will go into the classical, let's say, activities that the industry is used to do. And I believe this would also, if we would be more clearer in the industry about this correlation between business activity and impact for specific patient segments, I believe we would also turn the discussion with investors around. I can just encourage you to look into the ESG presentations that are made by the industry when they have an ESG investor day. What you will find there are often very great stories. And don't get me wrong, there's no reason to criticize access initiatives per se, that's not the point. But the way we talk about it is insufficient. So you go into those presentations and what you find there is a nice narrative about an activity. And then you find indicators again, such as patient reach. What you rarely find is any information on revenue. Is there any revenue created with that activity? Is there any profit created by that activity? And that's an important data point, because if we would not, or if we don't do this, we will never be able to prove the economics of impact. We will never be able to show from a capital allocation perspective that this is the right thing to do. So there are, I believe, great opportunities in the industry, a lot of challenges, and unfortunately, I believe we are not where we need to be, and the time is ticking, so to say. I think it's something the industry really has to come along and do much more diligently and thoroughly, and together with academics and other parties. Just one last word. When we talk about economics of impact in our industry, one of the barriers that pharma companies are often struggling with is not the medicines per se, but the enabling environment, the enabling ecosystem, right? There is no medicine available, no GP available, no general practitioner available that can diagnose a patient. There's no properly working health service, etc. If we would understand economics of impact better, we would also understand better whether it's worthwhile to invest into health service strengthening or health system strengthening as a genuine activity of the pharmaceutical company together with some partners. Because then we would understand this investment makes sense because it drives revenue, and at the same time it also drives outcomes and patients from outcomes and impact from a patient perspective. So that's another thing I believe we could create a lot of more clarity if we would have a better understanding of those kind of correlations and the data that we need to have in order to prove that.
Thank you, Michael. Yeah, you circled all three, which is, if we do this much more rigorously, and I heard your premise, actually, we're not quite there yet, even on the impact side of the outcome measurement.
Yeah.
But if we do that, we can inform internal choices.
Yes.
But we also, in a way, can inform choices of players outside our company, namely the health system, about the opportunities to jointly optimize the quality and the profitability of reaching those patients. And thirdly, you said, if we start informing ourselves and others, we can begin to inform investors about the choices that we're making. And this is where, again, it gets really powerful, because we can inform them where the model works, where we're creating shared value, and we always have been in healthcare, but where we've got a road map to breaking and innovating and collaborating ourselves out of trade-offs, and why we're going on that road and why we should, in much more informed basis, as opposed to being dismissed from the outset about embracing trade-offs, which, you know, is the constant sort of taboo, right? Where we
Yeah.
don't go. And that's why it's so important for us to go in this direction. And this, I think this was, the link to this conference, because while it starts in the company, this is also about informing investors and guiding their choices about where to allocate resources. And maybe you can, particularly with your background, Catalina, help us better understand that. Why is managing the economics of impact so important?
Yeah.
To the financial sector, the investment.
Thank you. Yeah. So the why we thought it was important to bring this topic to this conference was that we are always trying to build bridges between the financial sector and the impact world. And actually, one of the problems is really that there is not enough economic insights on what really it means to achieve change. So basically, our idea is that a deeper understanding of the economics of impact can really drive investment where it should go. And then I think this is really something that could, take all the momentum and the excitement behind impact investing and ESG investing to really changing the real world, because the promises of the sustainable investing community sometimes are very nicely publicized. And of course, there is a lot of great work behind it, but many times everything remains in the financial market, and the real economy is not so impacted. So I think this approach can really help, investors, engage with companies in a more proactive way to really see where there are opportunities to invest that have a clear impact that is sustainable over time, because it's aligned with the economic incentives of the company, of the stakeholders. In the case of India and Mars, the farmers. In the case of Mexico that I was sharing, also the laborers. In the case of the pharma, also the customers and the whole environment, the doctors, the hospitals. No, so all of that is very important. I think my dream will be for this to really become the new way in which there are impact investors can find opportunities. Basically, if we could really do this type of analysis for select pilots that can really drive learnings that are strategic and can drive systemic change, then you could attract impact investors to really start investing in this type of things that have a very, very clear impact beyond just reporting on the number of people that you reach. That ultimately doesn't mean really anything, and that's what people do, and it's costly, it's difficult, but it's not really what we need. So I think that's important, shifting a bit the conversation, being a bit more humble in the sense that it's not just about throwing money at the problem, because money by itself never solves anything. It's really about understanding how you can use that money and learning from different pilots, so that we can really have a systemic view of the things that we should be pushing for. So I guess my view will be that really this should be more connected to the impact investing world, but of course the sustainable finance and the ESG investing world could also be impacted, because the engagement conversations, proxy voting, and all of these things could be much better informed when they have a clear sense of what is the economic value of the changes that are discussed. Like if you are in an engagement process and you are, for example, engaging and voting for a shareholders resolution, and you know exactly the cost of the change and the impact that that's going to have on business, then of course you are much better informed and you have a clear idea of what things could look like, instead of just being driven by the new conspiracy theory or the emotions of activist groups. So I think this is a very powerful, and feel very lucky to be able to work on this topic.
Catalina, and please, Michael. Yeah. And
the investor business nexus is really a hugely interesting one, because there's so much movement happening at this moment. I have started to talk with investors many years ago, and there was rarely a take-up, right? These were side conversations, if at all. In the meantime, there is almost no conversation, even with mainstream investors and sometimes sell side and buy side, where the topic of ESG is not at least mentioned. And that's a very positive change. However, I'm sometimes surprised how, can I call it, erratic or irrelevant the conversations are, right? When you are in the pharma sector, the central point of every discussion with an investor on ESG topics or on market development should be guided by the idea of materiality. What is really material to the industry? And this is in our industry not, let's say, waste as an example, it's access to medicines. However, when you go into the discussions, you often find discussions or wide debates about why are you doing this in the waste area instead of this? And there is rarely a discussion about how do you really drive access and do it in a way that could drive revenue so that you can scale and replicate, but also achieve much more societal impact for patients. So what I think we need to do together with the financial sector is to create much more clarity. What is really the central core of our activity? Where is materiality? And I believe this idea of economics of impact can help us to do that, because that's one of the starting points of the concept that you say, where is this overlap? Where is the impact that we should create as a company and as a sector? Let's focus on that, which does not mean that you should not do the other things. That's pretty clear. We have to look at climate as a pharma company. There's no debate about that. But in terms of impact, the area is access to medicines, where we need to get our hands around and where we need to invest and show better proof that we actually do this on a sustainable basis. And concepts like this could help us to do that. For me, this is a big learning journey. For the financial sector, because they don't really understand this well, and we don't understand it neither well enough. So it's a great learning opportunity, but we really need to do this fast. That's of course an urgency issue.
And we can, because except for perhaps not having yet the perfect outcome measures, which does hold us back, we have all the tools. We don't need to invent them like other proposals out there. We just need to do the math, and we need to use the math to inform choices and link that to investors indeed. Probably more the proactive investors, the private equity, the impact investors, probably not the institutional or just, going through funds, but the ones who actually want to understand and allocate their resources in ways that drives those outcomes. So that's why we're here, why we think this is an important topic. Thank you for joining us. This is the time we really invite questions, discussions, comments, thoughts about what resonates, what else we should be thinking about. Be happy to, and Dave, if we can get you back on camera, that would be nice as well, if you're still around. There you are.
I'm here. Yeah, no, I didn't run away.
Good. Hope you grab the tea in the meantime. Thoughts, reactions? Feel free to introduce yourself as well. I know some of my colleagues here, but yes, please.
Yeah.
Perfect.
Okay, it works. So hello, thank you very much for the presentation and the discussions. I'm Julie Montels. I'm working for Inox Capital as impact analyst. So all the topics you were mentioning really make sense to me. We are an impact asset manager working to provide debt to agricultural commodities businesses. So our mission, really impact mission, is to build more sustainable commodities value chains worldwide. And so for that, we really integrate impact and ESG criteria. And Catalina, what you were mentioning about engagement, it's also an aspect that is really important. And we developed during the recent years, because we saw and we believe that just basing our decisions on investment criteria is not enough. And to drive changes, we really need to now engage. And this is why we also developed projects such as technical assistance to our investees, based on the market system analysis. So it joined as well on the fact that we should really not only looking at the investee and company itself, but having a more general look on the system, how it works, what are the incentives, what are the constraints from norms, infrastructure perspective, etc. And so I have several questions. The first one may be, when you were mentioning the project on sugar, It's true, and this is also what we have seen, for example, in the technical assistance we have with a groundnut processor in South Africa, looking at the incentives and constraints. From a theoretical perspective, I mean, it's beautiful, and it's how we should see it work. But concretely on the practical, so we had all these incentives, such as, for example, the same with the having different compensation incentive for different actors. In reality, for example, if we take the cutters, that should be pay on the basis of the area cultivated or cutted. When we talk with the mills, it's something that is still quite complicated for them to implement, because they would need to have a concrete transparency and traceability on their supply chain, which is not the case, and which requires a lot of investment as well. And that's the demand. And this goes to David, maybe, is not still ready to pay for. And we have a lot as well of examples. For example, we were just discussing with a cocoa processor in Estonia and really asking how sustainability integration is done by the company. How do they look to their supply chain? But for now, he was just telling us, of course, we are interested in sustainability, but we have no demand for it, and everything is driven by our demand. And for example, Mars is doing a lot of things on that, but it's still quite rare as well. And all the food companies are not at that level of expectations for now. So yeah. It's, yeah, my question are, I think, two things: how to transform theory into reality, and pragmatically how to incentivize and also align the incentive of companies to change and implement this. Thank you. Yeah. Thank you. I'm actually very glad that you asked this question because I think I missed, completing the picture. So thank you for that. What we are doing now is getting started for the implementation phase of everything that we found. And one of the big things that we did was to really understand what is the cost benefit of this strategy that I was explaining before. So we model exactly how much would it cost to the mill and to the farmers and to the brands to pay cutters and cabos and farmers in this new way. Mm-hmm. And how much the income of these stakeholders would increase. And basically, if you compare these two things, it's amazing. Like basically, the increase in cost is almost nothing, like maybe 1% of the margin. But really, like if you are super, easy with the numbers, it could go that big. But in reality, it's very, very small. And then the impact on the cutters and the farmers and the cabos can be between 15 and 25% of their income that is increased. So that's one of the big things that we did, is really do the math and say, and bring this to the mills and to the brands and say, you think this is huge, but it's in reality, it's nothing compared to the value that you are getting from the sugar that you're sourcing from this, from these locations, and that these people are cutting for you. That's one of the big things. The other thing that we are starting to do, and hopefully we will get started in January, is to work with a blockchain provider that really helps identifying who are these people and mapping them in the supply chain. They have a lot of experience. Well, this is very new. Of course, the technology is very new. It's 6 years that they have been doing this. And they have around 2 million people in their platform already. They are in 40 countries and in many supply chains in many crops. And now what we want to do is to start with a pilot so that we really map who are the cutters and understand fully how are they being paid and how we can shift that payment going forward. And also you can also get the immediate reaction, oh yeah, but that's expensive, it's difficult. Mm-hmm. In reality, it's nothing compared to the margins of the mills and to the margins of the brands. And if you get to really put together a collaborative group, like we have a collective action group with different brands, you can share that cost. No, so that's what we are aiming to do. This is going to create full traceability for the brands. Sometimes that's also a problem because they get scared of what they will see. No, but they could also use that to for really reporting on a more precise way who are these workers and if they are really complying with no child labor and all these things. So basically, that's how we are taking this theory to practice. And we know this is going to be a long journey, but we are getting started with strategic pilots in hopefully 2 mills in Mexico. And we hope that we will be able to share that knowledge with the full sector and hopefully other countries in the future.
Okay, thank you.
Yeah, I think one of the issues that is related to that, and you get at it in the pharma sector as well, when you start talking about prices of medicines, and you try to do that in a collaborative supply chain context where you cannot discuss prices without being in antitrust. Antitrust is a interesting challenge to managing the economics of impact collectively. The way we are seeing how to do that is around understanding the true cost and value of change, understanding the respective profitability of the players, and then saying, now you need to embed the cost of that change in your terms of trade, which means it defaults back to the individual negotiations between brands, suppliers and their suppliers, with a clear understanding of what it will take to drive the change forward. And so that's a very interesting sort of flip to how do you manage that collectively without breaking the antitrust rules that often stop us in these kinds of considerations. There's probably a whole track here on the economics of impact and antitrust law that we should probably get to know more and explore, but yeah. And so it's in how do you, it's again, it's having the understanding of really granular of the detail and then giving that as choices to the actors involved changes the game and changes the tone. And then making sure that what needs to be transparent cannot be broken through old mechanisms. And this is where digitization really helps.
Mark and Catalina, yes. Can I just Please. Build on the points in the question as well, which with your sugarcane example or the mint example, it does take I guess the need to understand I would say the total cost of ownership, because if you're a procurement team and you're saying, okay, well, what's the cost of sugar or mint, and it's, well, there's a kind of average cost, and what you should be doing is saying, well, okay, prove it. Prove to me what that cost is. And so I think the work, Catalina, that you're leading to, and I know from the work in Shubmint, is you actually really do take a look at, well, what are the costs of labor? What's actually driving the behavior? And then you have some wonderful aha moments. You go, well, actually, we really begin to understand what the total cost of ownership really is, because if you're a responsible and purpose-driven business, you're worried about these things. But then you actually, once you confront it and you understand it, you realize that you can actually make a brilliant impact. And in both examples, the actual total cost of ownership is actually going to go down, but you've driven a massive impact. All you've really done is really understood what all of those costs are, rather than someone giving you an average and they didn't really understand what was affecting the cost. So there's some brilliant aha moments here. And again, why I get very excited about this in terms of procurement with purpose. And it just makes complete business sense, because both examples, I think we gave from the agricultural side, I mean, that's going to be your competitive cost. I mean, imagine if you were just certified and you said, oh, I've got it all sorted out, certified. There was no way you would have understood really what's going on to the depth that Catalina was talking about, and I think I've shared with Shubmint. So some brilliant insights here.
Thanks, Dave. And I do remember that some of the triggers for this work was looking at what we call the cost threshold of change versus the certification amount that was being spent per tonnage of commodities, and saying we are certainly not at threshold. And when we look at what certification spends, it spends 5% on the ground and 95% in process. So we're really not going to get there. So, but then we also learned that the threshold of cost of change is actually not cost, it can be value. And that's the fascinating piece, and that can be shared in the system. So from the big picture of economics of impact is absolutely crucial in front of us right here. We say it's frontier because we can see it's not fully adopted or resolved in industries, and we need to do that. at the highest level, we think is absolutely key and fundamental to shifting to a new economy. And then you very quickly go really deep in the details around each specific sort of market, products, choices that the company faces. So it's a distributed agenda then within a company. But we believe in it, and thank you for joining us. Are there other questions or comments? Or should we all go to? Yes, please.
Hello, can you hear me?
Yes.
First of all, thank you for a fascinating presentation of your thinking. It's very compelling. My name is Patrick Hayden. I work for B-Lab, which is involved in certification and systems change. And as I was listening, Katerina, two questions, if I may. One is, measurement of impact and the long term. So take the specific example of sugarcane. You're talking about incentivizing productivity. How do you think about productivity, not just yield this year, but yield for the long term? Because obviously, regenerative agriculture is something we need to incentivize rather than sort of short-term yields. And I think that's probably a general question in impact management generally. It's easy to manage the impact this year. How do you think about the 5-year, the 10-year, the 100-year impact? And I'm just interested, maybe a more general thing up front, if I may. You characterize the world as ESG disjointed from strategy, which I think is there's a spectrum, as we all know, from companies that actually ESG is actually what they're all about. They just happen to be a business that enables them to do it all the way through. And you mentioned it's all about the math. So I'm just curious on your view of, is there some other purpose of the business than just doing the maths and maximizing profit? Or is there something else we're all about?
Should I get started? Thank you so much for that question. So yeah, that's the other piece of the puzzle that we didn't mention. Actually, we have here our colleague, Emma, who is working at the moment to really understand that. So we are looking at the farmer economics and how to really improve that over the long term in terms of, really analyzing where the yields are coming from, and really how you could shift that so that it's becoming more sustainable over time. So that's a big component. There we think, of course, like training and access to better inputs and better practices is going to be key. And we are starting that analysis. Our focus was firstly, the social component of this the cutters and the laborers. But now we know that over time, like if we want this sector to be sustainable, and if we want to really increase value and finance all this change, one of the big levers is really improve the productivity of the farmers and do this sustainably with a better management of agrochemicals. For example, one of the conversations that we had with one of the meals was just about that. Like if you tell farmers how to, use agrochemicals in a better way, they can both diminish the cost of production because you save in the inputs quite a lot, and you increase your productivity over the years by 25% and diminish the cost by, I think it was 50% what they were saying. So we are getting started in understanding that. That's part of our second phase, and that's going to be very, very powerful.
Yeah, we have the same question on timing, for example, in work we're doing on climate adaptation finance. And since nobody really knows the pace at which the effects will appear, it's very hard to plan for returns on investment and financial instruments, whether we're looking at a 5-year horizon or 10-year or 20. So the uncertainties here do create some difficulties, but certainly in issues like, the planting materials, that's used in sugarcane, there are all these varieties. It may be that the high yielding varieties are not the right choice, right? Because they're actually something that yields a little less, that's, able to resist and be much more water resistant is actually a better choice. And these are things that we are looking into. I think that the purpose of business is to be the principal engine to, people talk about, to address our global challenges and these are threefold, and their climate, their resources, and their wealth and inequality, and giving opportunity to people. broadly across the world. And we need to, and we are reinventing all the business models to try to achieve that. My colleague, Mark Kramer, talks about 3 types of companies. And I think that's a useful framework. He says there are the natural shared value companies. They're the ones we're creating today that already are designed and aimed to fulfill those objectives and to sort of optimize our societal and our financial outcomes. It's interesting that even doing the math there is not done as much as we would want to. And what we see when you begin to do that is just like a discovery model. Insurance, right? Absolutely zero laser focused on driving positive health or safety outcomes in order to be more profitable. They haven't yet cracked exactly how to do that and deliver that for lower income populations. And so they need to continue to optimize and unlock insights to go there. So even they're doing the math and what would it take really, even in a great shared value business, to actually reach new segments is part of what we're talking about of the economics of impact. And may itself, even though you're a shared value company, drive you into temporary trade-off in order to even amplify the power of your business model. Then he talks about the businesses in transition, right? Where our second scenario is the dominant one, where we believe there's an opportunity to innovate and collaborate out of trade-offs and to rebalance those propositions to deliver on all these objectives. And that's obviously a really important piece of doing the math, because it gives you the pathway to innovation and collaboration. And then there's them that we should just starve of resources and talent, right? And that's the third type of company. So I don't know if that helps, but I know the B Lab is very, very aligned with obviously everything we're talking about. So thanks for joining us too.
And Mark, can I add? I think it's David. I think it's a great question. You know, is it about profit or is it profit and purpose? And I think if it were just about profit, yes. I don't think that is it. I think businesses are there certainly for purpose, and it's becoming. I think most businesses are becoming really aware of probably why they actually started. And I think there's some great quotes out there, even from Henry Ford, who actually alluded to that as well. If all you're in business for is profit, then you've actually missed the point. And it's a little bit like breathing, isn't it? I mean, you have to breathe to live, but if that's all you live for, then you've probably missed the point. I think it's a good closing question, quite philosophical, but I think it touches on everything. I think all of us are driven by purpose. So I think the economics of impact, Mark, and the work you and Kathleen are doing are actually just making the point that you know, it is beyond profit, everything that business is doing, and just making that really clear. Great closing question.
I 100% agree. Purpose-based economy has to link systematically the outcomes, or else we won't get there. Thank you.
Thank you so much.